Well, welcome back as we head towards the end of the year. Pretty rocky on Wall Street these days, and yet unemployment all-time low, economy all-time high. What's going on with that? And if you are currently involved in this program called 1031 exchanges or capital gains, and how would you like to avoid them? Well, there's a new program out, and I'm delighted to have with us today our good friend Joel Block. He is a financial expert. He's a venture capitalist. He heads up Bullseye Capital, and you can go to bullseyecap.com is his website. Hey, Joel, good to see you. Merry Christmas, buddy.
Hey, Terry, man. Good. Merry Christmas to you, too. How's everything going? Been busy, huh?
Oh, man. I got to figure out a way to work less and get paid more. You got any ideas?
How much time do you have?
Okay, there you go. Hey, listen.
I got plenty of ideas.
Before we get into this new tax shelter thing, which is an incredible idea, Wall Street's been a roller coaster, and it looked like it may end up down this year. Does this trigger inflation or recession? What's your take?
Well, listen, the word is that, a recession's not that far from now. I think the fundamentals are pretty strong in the economy, but you got to remember the stock market is a behavioral kind of a deal. It reflects the way that we behave. So if we get nervous, it goes down. If we're, excited, bullish, it goes up. And it really works that way. And I think that people have been excited for a long time, and they're ready to just take a little breather. And that means things are heading south for a little while. So that's how I look at things.
Because it's kind of odd. It would be so rocky and roller coaster when all the other numbers are so strong.
It doesn't make sense to me. But, listen, I'm not a guy who follows the stock market that carefully. That's not really my side of the business. So but it really is surprising to me, too.
Okay. All right. This new thing called Opportunity Zone. For all the real estate moguls out there doing 1031 exchanges, trying to outrun the tax man, this might be an interesting fix, huh?
This is bigger than that. This is bigger than real estate. It's bigger than 1031. I mean, this is really, for all kinds of guys that are doing anything where there are capital gains involved. Here's the deal. President Trump's whole posture is that the private sector does things better than the public sector does. So he wants to bring a lot of money into these distressed communities. There's an awful lot of pockets in the United States, bigger than pockets. I mean, pairs of pants. I mean, giant swaths of land where the United States is not doing that great. And in some of the urban communities, we're all doing very well. But there's lots of places not doing well. And he wants to bring a lot of private investment capital into these communities. And the way he wants to do this is by trading capital gains taxes that people have accumulated and let them put that money into other places. And that's this new program, which was snuck into the Tax Cuts and Jobs Act of 2017 that was passed last December. Most of us didn't even know about it until pretty recently. It's something that kind of happened under the radar, but it is a giant program with an awful lot of potential.
They're calling it the Opportunity Zone. Who defined it, and where are they?
So here's the deal. So it's built in these opportunity zones. What they did is they asked the 50 state governors to propose these zones where they wanted investment to happen, and they had to be meet certain criteria. They had to be certain low income kinds of environments, and they submitted that to the IRS. The IRS compared that to the census tracts and approved about 8,700 of these opportunity zones across the country. So what that means is if an investor now invests in an opportunity zone in any one of these 8,700, and you can't really do it directly, you got to do it through an LLC or corporation, or probably even better, you need to get into a fund where this is happening. But these funds are popping up. Guys like me are setting up funds, banks, all the kinds of institutions are setting up funds, and they're putting money into these distressed areas because the tax advantages for doing this are probably record-breaking. In my years of being in the investment business, the tax business, I've never seen anything like this.
I understand we got one in our own state, in Portland. They call it the Pearl District. So anybody that's dealing with the capital gains can get involved in this?
Yeah, and so here's what happens. So anybody that has a capital gain, whether it's from real estate, whether it's from something else, if you take that profit from the capital gain and you put it into one of these opportunity zones, what they'll do is they'll basically, over a 10-year period of time, they'll erase that capital gain so you don't have to pay it. And all the money that you make in the opportunity zone is also going to be erased. Now, let's say you don't have any capital gain, you just want to invest. I'm thinking that investing in opportunity zone areas is probably going to be a pretty good investment, because on the basis of supply and demand, if a lot of people start demanding these properties, then the property values are going to start shooting up.
Yeah, so whether you're in that tax problem or not, it may be just a good investment.
Listen, it's kind of a roadmap to a good investment.
You and I have seen where you've taken downtrodden areas and somebody starts the ball rolling. Sometimes it's usually old cities. The old downtown area of a city gets revitalized, and all of a sudden it becomes the hub again. And is that is that what we're talking about?
That's what the people who are behind this are hoping happens. It's a whole gentrification process, and by moving in this direction, by moving money in these environments, that's exactly what happens. Let me just give you a sense about how much money is at stake here. The IRS believes, and they have records and all this stuff because they have all of our tax returns and everything. They believe that there is about $6 trillion of accumulated and deferred capital gains that are available to be moved into these kinds of programs. Now, a lot of this money will never be taxed. So they're not really, it's not like the government's saying there's $6 trillion in potential gains and we're going to get about $1 trillion of that. The government will probably never get a lot of that money because, number one, when people die and they will their properties to their heirs, a lot of those gains go away. So an awful lot of that stuff's going to go away all by itself. The second thing is a lot of this gain is owned by corporations. So about $4 trillion is owned by individuals. About $2 trillion is owned by corporations. Corporations have an infinite life, and so maybe they never sell their properties. Maybe these things never get taxed. So in a certain way, by encouraging people to move this money, which the government may never even get its hands on, they're actually stimulating growth. So we started by talking about the stock market. I can't tell you what's going to happen with the stock market, but I can tell you that a program like this creates great fundamentals. Because when people move money into these communities, it creates jobs, it creates construction. And by the way, this isn't like an apartment fix and flip where you just put a little bit of paint on a building and you're good to go. It has to be a substantial improvement. There are specific rules that say that you have to invest 50% of the value of whatever you bought. So if you bought a piece of land or a dilapidated property, you got to put 50%. And some of these rules, by the way, they're not finalized. The IRS is still finishing up some of these things. So we can come back, in a month or so, and we can revisit what the final rules are. But you have to make a substantial investment. And by making a substantial investment, we create a lot of jobs, which creates a lot of payroll taxes. It creates a lot of income taxes. It creates a lot of everything for both the government and the community. And then those people get ongoing jobs. It's a terrific program that moves a lot of very fundamental services into these communities. And when those people do better, we all do better.
Are you talking about this at your website? Can people get more information there?
You know what? We're actually building something into the website. So in the next handful of days, we have a brand new white paper. All that'll be available on the website in a couple of days.
Okay, that's bullseyecap.com. One of the things that comes out of this, Joel, if you have this capital gains rollover into one of these opportunity zones, I would assume that part of that requirement, you're going to have to be able to sustain that investment until such time that area begins to build and go, right?
Well, it's a 10-year. There's a 10-year requirement. I mean, it's long, patient money. So if you leave it there for 5 years, you get a little bit of tax abatement. 7, you get a little more, but 10 years, you get the full abatement. And so they really want you to hold the money for a long time. They want you to be patient. They want these communities to really have a chance to really get the engine going and really make this happen. So these are great programs. I mean, this is something in all my years, this is the greatest tax shelter that I've seen in American history. And I hope it's successful for these communities.
Can you pool tax shelters together? In other words, if you had 4 clients that had capital gains, could you put their 4 capital gains into one project?
That's what funds do. So funds allow for people to put their money in, and then somebody like me goes and buys the property and develops a shopping center. Most people don't have the money by themselves to do these projects. Most people don't have the skills to actually roll up their sleeves and do a development. So you really have to work with people who know what they're doing. And by the way, let me just say one last thing, that just because people with means start throwing money at communities that are disadvantaged doesn't mean that these communities want the money. It's a little bit counterintuitive,
right?
But there are lots of examples where companies like Walmart have gone in and said, listen, we're spending 20 million and we're building a Walmart, we're doing all this stuff, and the community rejects it for one reason or another. A lot of times these people don't want to be pushed around by people with means, and they're proud people that just don't want to be pushed around. So you have to make sure you're dealing with promoters and dealing with fund managers that have relationships with these communities, that can go into these communities and be successful. It's not just about aggregating funds. It's about deploying capital in a reasonable way and getting these projects done in a way that complies with the government rules and also that works with the communities and does well. So for all those reasons, you got to be a little careful.
Well said. Thanks, my friend. Thanks for your time. Merry Christmas to you. Let's stay connected.
Hey, you too.
Yeah, let me say to our viewers and listeners, go to Joel's website, bullseyecap.com, and then look for this white paper on the Opportunity Zone. Thank you, friend. God bless. Have a good one.
You too.